they also may lack the charisma and force of the founder. I find that in many of these businesses where the founder was the driving force that made the business as successful as it is today, when that founder leaves, the business sputters and fails in many cases. And the founder's always looking for somebody like them to replace them, but it's impossible, usually impossible to find somebody just like the founder, because they may be a combination of entrepreneur, manager, business developer, administration officer, everything. You know, chief cook and bottle washer, all wrapped up into one. And it's hard. And usually what they'll find is they have to replace themselves with 2, 3, or 4 people. And then how do you run a business like that with 2, 3, or 4 people? You can. There are successful governance models that allow you to do that. But it's a challenge for founders today. With so many businesses being for sale, it's definitely a challenge. So the ESOP, Rick raised the question of, you know, when are ESOPs, you know, beneficial, when are they not? I mean, ESOP is a qualified plan. So like your 401k plan is a qualified plan, and ESOP is a qualified plan. And it's for the benefit of employees of the company. How does an ESOP work? Well, you have a company that contributes cash to the ESOP and gets a deduction for the contribution, just like they would on any contribution to a qualified plan. And the ESOP then uses that cash to buy out the founder or the seller of the stock. It might be more than just the founder. And there are limitations on how much money can be put into the ESOP and how much money can be spent by the ESOP. But generally, if you have enough people that participate in the ESOP, and it's got to be non-discriminatory, so that it has to be able to cover all employees, basically, who are eligible and qualified under qualified plan rules, under ERISA. It has to be non-discriminatory. As long as you have enough people participating and enough cash flow coming into the ESOP, it can buy out the shares of the founder. The cool part of an ESOP is that you can have what's called a leveraged ESOP, where the company arranges for the ESOP to borrow money from a bank, and the bank lends the money using the company as a guarantor, usually, of the ESOP. But also the shareholders may have to guarantee the debt. So that's the downside of it, but the debt can be used, the cash from the debt can be used to purchase the shares. Now the sellers have generated liquidity for their privately owned company shares. The ESOP owns the shares, but now the debt has to be paid back. So how do we pay back the debt? The company has to generate enough cash flow to do this. So Rick, your question is really dependent on the company and what it's capable of doing in terms of cash flow generation, the ability to service the ESOP debt, and the structure of the ESOP. ESOPs are beneficial because, for example, if an S Corp sets up an ESOP, any shares owned by that S Corp are held by a tax-exempt entity. So all the income from the S Corp that's allocable to the ESOP, whether it's 30 or 40% or 20% or 30%, is tax-exempt. And you would think, well, wait a second, I thought tax-exempt organizations cannot own businesses. They have what's called unrelated business income tax that they have to pay tax on. Well, there's an exception for S Corps for ESOPs. It was enacted, I don't know, 15 years ago or so. And it's been in the Internal Revenue Code. So that's why S Corp ESOPs are really popular. So all of the earnings from the S Corp that are held by the ESOP are tax exempt. And so it's growing inside the ESOP. It can be used, again, to purchase more shares or to pay out terminating employees. So some of the pros for selling shareholders of an ESOP are that it creates a market for privately held stock. It also, if it's a C corporation, not an S Corp, allows the owner to sell his shares and then reinvest those proceeds into publicly traded securities under Code Section 1042. It's a 1042 rollover. It defers the gain on the sale of the shares to the ESOP as long as you invest in qualified publicly traded securities. If you put money into these qualified publicly traded securities and you hold it for at least 3 years, you were allowed to continue deferring this gain. And then when you ultimately sell the publicly traded shares and don't reinvest them, you have to pay tax on it at that point in time. The cons are that if you use one of these 1042 transactions, there are limitations, very strong limitations on what you can do after you enter into this rollover transaction. There's a 10-year freeze-out, 10-year period until all the purchased shares are allocated to participants in the ESOP. And there's an excise tax of 10% if you dispose of the shares that are held by the ESOP. So if they sell the company within 3 years of the transaction with the ESOP, all the 1042 gain gets recognized and an excise tax has to be paid. So it's not a good type of transaction for a company that's ready to be sold. On the other hand, if you've got the ability to pay for the ESOP, the other con is that, and there are many cons and there are many pros. In fact, we could talk about ESOPs for hours, but another con is they're complex. They're subject to ERISA. They're subject to ERISA reporting requirements. 5500s have to be filed. They generally must be audited. You must have an outside trustee running the fund. And it's very expensive annually because you have to pay an appraiser each year. You can't fudge the valuation. You must pay an appraiser each year to value the shares of the company. So all of these things add up in terms of cost. And the one biggest downside I've seen of ESOPs is when it's time to sell the business to somebody else. And there's an ESOP holding the business. The ESOP gets preferential treatment as if they were preferred stockholders across the board over everybody else. I had a client that was an owner of a company that was ESOP owned. It was one of your clients, Mary, and years ago. And they ran into problems when they were trying to structure the transaction with a private equity firm because the ESOP had to be favored in all circumstances, ahead of everybody else. Everything had to favor the ESOP. So, but I've had successful ESOP transitions. So one successful ESOP transition was Stanley Corporation that ultimately went public, and then they sold to CMGI. And that was extremely successful, where all the ESOP participants and the founders made out very well in the transaction. Any more questions on ESOPs? So they are viable. People are using them. They're specialists across the country. We work with some folks out of Baltimore that have done multiple ESOPs nationally when we're doing an ESOP, and very successful transactions. But it really does depend on the founder's willingness to give up control over time and the ability to keep the ESOP going after the transaction is consummated. The impact of the exit on employees, on you as the seller. There are various considerations you always have to keep in the back of your mind. What happens when a founder leaves the business? They're the driving force that keeps the employees engaged in the business. And often it takes the wind out of the sails of the business. So you have to have a management team behind the founder that really is engaged and ready to take over and wave goodbye to the founder. So the impact on employees can be significant, and if the founder's not sensitive to that, when they're engaging in negotiations for the sale of their business, the results could be devastating, particularly if there's an earnout associated with the business. The other thing is, when you sell your business, you might have treated your business as your personal pocketbook, where you've run some personal expenses through it. You can't do that if you sell to a private equity firm and keep any shares after that, or if you sell it, obviously, completely, you won't have the business to run your personal expenses through. And then the other big question that we always have is, what do you do when you sell the business? What do I do now? So focusing on that quickly, the employees want to know if they're going to be kept. Are they going to still be there afterwards? Well, you don't usually tell the employees until the transaction is very close to being closed. You can't, because the whole thing could come unraveled. Your business could come unraveled. The employees may leave. They may take clients with them. They may do devastating things to your business if you let them know ahead of time, and then they get scared and panic, which we've seen recently in another transaction. The founder wanted to tell everybody right away that this was happening. And a couple people left and left him in the lurch.